The biggest lie about getting the lowest mortgage rate is believing the lowest rate automatically means you're getting the best deal. You've probably been told to shop lenders and get the lowest rate when buying or refinancing a home. That advice is not wrong, but it's just not fully complete. By the end of this video, you will understand mortgages and how to actually get the best deal. The best deal is not always the lowest rate, it's what matches with your long-term goals. So let's first start with why people are told to shop interest rates. People are told getting the lowest interest rate possible is going to lower their payment the most, and that's what they should do to get the best deal when shopping for a mortgage. The reason it doesn't make sense is because sometimes people aren't just shopping for the lowest monthly payment. Sometimes they need lender credit to cover some of their cash to close. Sometimes their plan is to only hold the house for 6 to 12 months. Getting closing costs covered is a lot more advantageous than getting the lowest rate. For somebody thinking about just the lowest rate, in some scenarios that absolutely is what you need to get, and that is completely fine, but I think you need to look at it more holistically and what your actual plans and goals are, and have a lender that you can trust to really show you all those options, and then you can pick from there. If shopping rates alone isn't the full picture, then the next question becomes this: are lenders actually offering different pricing, or are we just comparing numbers that look different but come from the same place? Pricing is almost always the same. The only time there's ever a huge jump in pricing is when a client has significant assets with a bank. So unless you're somebody that has $5 million to be able to deposit into a bank for them to then give you a better interest rate, between us and any other like lender in the country, mortgage interest rates are almost going to be the exact same. One thing to make sense of this is if there was a company that just had the best rates, none of the other companies would be successful. Service and rate are two separate things. It's just a matter of how the lender presents it and what you believe is to be the best option. The real difference just comes from the service. Who do you enjoy? Who do you trust? Who's being transparent, not pushy? Who's showing you all the options and let you lead the way rather than them telling you what to do? Because I get competitor quotes all the time. They'll show a rate of 5%, but it will be 5 points to the borrower. So they'll have to pay on $1 million loan $50,000 of additional closing costs to get that rate. Where the client was told to shop for the lowest interest rate, they see 5%, don't look at anything else on the paper because it's confusing, and think that that's the best deal. If all lenders are dealing with similar pricing, then that raises a bigger question. If the rate is not the real difference, then what really determines what deal you end up with? Which brings me to my next point: how a mortgage actually gets structured. The reason it's important to understand mortgage structure is because oftentimes when a lender is getting shopped, they might hide fees or do some things to show you something that looks better based on what you're looking for, but hide things in the places you're not looking for things. So it's important to understand how it works and have somebody actually educate you on what levers push and pull what things so that you can understand what you're looking at. A lender might be offering a 4.99% interest rate, and all you're looking at is the lowest interest rate. And you compare my offer to their offer. Their offer is 4.99, mine's 6%, right? So that's a full percent better. Of course they're gonna go with this option. Well, what they're not looking for is that this option has $50,000 in additional fees to get the rate that low, where mine has $0 of additional fee. Which deal is better? So when you're getting a loan, there's essentially two things. There is an interest rate and then there's closing costs. And people are always shopping, usually one of the two, not both. What a mortgage loan is what your monthly payment is gonna look like over the next 30 years. There's the monthly costs, and then there's an upfront cost. It's up to you to determine whether or not you want the monthly cost lower and the cash to close higher, or the cash to close lower and the monthly payments a little bit higher. And that leads me to breaking down the three options. Option one is par rate. And what par rate is, it means all the revenue that we have to give goes towards the interest rate, and you get that interest rate without having to pay any additional money, but you also don't get any lender credit to cover any closing costs. The pros of this are there's no real additional money spent than the set closing cost because you're not paying additional for the rate, and it's usually a pretty decent rate as well. The cons to this are there are potentially lower rates available if you want to pay for a lower rate, or you could take a slightly higher rate and get closing costs covered. This option's for somebody that maybe has seller credit to cover the closing costs, or maybe they have enough capital where they are okay to pay closing costs themselves, but don't have enough capital to pay the interest rate down any further. This is not for somebody that is tight on cash to close and needs lender credit to cover some of, if not all of their closing costs. And it's also not for somebody that's willing to pay down the interest rate further to get the absolute lowest rate available. The second option is paying points. And what that looks like is if the par rate is 6%, depending on how many points you want to pay is how low you can get your interest rate. So if your loan amount is $1 million, a point is $10,000. And a point, depending on the interest rate market, changes how far it lowers your rate. So for instance, maybe the par rate is 6% and paying 1 point, so $10,000, gets you to 5.5%. And then maybe paying 2 points only gets you to 5.375%. A point doesn't absolutely equal being able to lower your interest rate 1%. That's a common misconception, because if that was the case, I would just say pay 6 points and your interest rate would be 0, and you can't do that, unfortunately. But the more points you pay, the less it moves the needle. So the first point might get you a whole 0.5%, but then the second one might only get you 0.25%, and maybe the third one only gets you 0.1%. The pros for this are you get to set your payment essentially. If you don't want to purchase a house without having a rate of 4% and you are okay spending a little bit more or a lot of bit more on the cash to close to get there, we can do it. The cons are it's expensive. So if you want to pay 3 points on your $1 million loan to get to the rate that you want to get to, that means your $10-ish thousand closing costs actually turns into $40,000 because we're paying the closing costs plus the 3 points. This is for somebody that cares a lot more about monthly payment than they do cash to close. And it's also for somebody who doesn't think a refinance opportunity is in the near future, and we'll talk more about that later. This is not for somebody that has a cash to close issue, right? If we're paying a bunch of points and it increases your cash to close, if you don't have that money for your cash to close, then this is not an option for you. Option 3 is taking the higher interest rate to get a lender credit to cover some of, if not all of your closing costs. So what that looks like is if the par rate is 6%, maybe I can give you a 6.5% and then use the revenue instead of towards the lowest rate available at no points. I can use the revenue to pay for some, if not all of your closing costs. The pros of this are getting your closing costs mitigated potentially to 0. And the cons of this are you get a slightly higher interest rate. I bought a house and I got seller credits to cover all of my closing costs, but not to cover points. So I just took the par rate and had the seller pay my closing costs. So my closing costs were 0. I didn't have to take a slightly higher rate to get a lender credit to cover my closing costs because the seller was already doing so. And I didn't want to pay points because I didn't want to increase my cash to close. And I also knew I was going to refinance in the near future. If interest rates were super, super low and I never thought there was going to be an opportunity to refinance, maybe I'd pay a point or two to get my rate as low as possible. Here's where most people get tripped up. They hear all these options, but still believe the lowest interest rate has to be the best choice. So why does that assumption get people into trouble? Our next point is why the lowest interest rate isn't always the best deal. If somebody's chasing the lowest rate and there's a bunch of points tied to that rate, it doesn't always calculate to make sense. If getting a rate of 5% costs 5 points on $1 million loan, that's an extra $50,000 that they have to spend. But going from a 6% rate to a 5% rate might only lower their monthly payment by, call it $250. So then what you do is you take your calculator and you divide 50,000 divided by the $250 per month saved, and that's 200. And then you divide 200 by 12, and that means the break even on that additional money spent is 16.6 years. So if you think you're gonna own this house for more than 16 years and not have a refinance opportunity, then yes, that deal does make sense and you should pay those points. But on average, people own homes for 5 to 7 years and they refinance 1 to 2 times in that 5 to 7 years. That's also not to mention what you would do with that money otherwise. So it's 16.6 years, assuming that $50,000 is just sitting under your bed. But what if you invested that at 10% interest? Well, that 16.6 years actually might increase to 20 or 25 years. Well, the loan's only 30 years. So at a certain point, it absolutely doesn't make sense to pay points. If somebody maybe does do the option that I talked about where they pay $50,000 in points and the break even is 16 years on that money, and they do refinance or sell the house before that time, It's just money down the drain. They saved $20,000 of that $50,000 of points because they sell the house in 6 years rather than 16 years. They kind of lost money and didn't end up getting a good deal. Talk with your lender about all the options and then ask them what they think is the best option for your situation, because before even giving any options, I'm having conversations with the client of what's most important to them. Is it monthly payment? Is it cash to close? How long do they think they're gonna own this house? When do they think there's gonna be a refinance opportunity? And then once we put that all together, I'll still give all the options because that's the right thing to do. But then I'll say, hey, based on what you've told me, which are these things, I think this option makes the most sense because of these reasons. That's why there's so much nuance to this, and the advice of taking the lowest rate possible can't possibly make sense, because how can there be one size fits all advice for all these different situations that everybody's in? And this is where things start to go wrong with a lot of borrowers. If people do not understand these trade-offs, how do they know if a lender is actually helping them or just pushing a deal? So here's where rate shopping goes wrong. The advice is always go get the lowest rate, go get the lowest rate, go get the lowest rate. One initial red flag is when a lender shows you a rate and doesn't point out the points to you. So if they're sending you a quote and are just leaving it up to you to look at the fine print to see where the points are, if there are any, and don't tell you straight up that there's this many points on this quote, but we could also do these other options, huge red flag. People should be asking, is there points tied to this rate? If we get in contract today, is this the rate that's available? Is there anything we need to do on the underwriting side of things or application side of things to really know if this rate is actually accurate or not? I like when people ask for more than just the lowest interest rate and actually get to talk about what their circumstances and what is important to them. I can say, hey, I can get you the lowest rate. Here's what the lowest rate looks like, and here's what everything else looks like. But based on what you're telling me, here are the other things that I think might be important to you. So what do you think about these other options as well? Investors oftentimes don't shop rates. They just have somebody that they know takes care of them and trust them because they've already had those conversations of, hey, I think I'm gonna be able to refinance in 2 years. I want you to pay for my closing costs because getting a lower rate is not gonna break even. I have many clients that are investors that I've done 5, 6, 7, 8 loans for that they just sign whatever I give them because they know that I have their best interest in mind and are getting them the deal that makes the most sense for their goals. Oftentimes the problem is not the rate itself, but the lack of transparency. The real solution is trust. That brings us to the role of having a real lender relationship rather than just the transaction. Understanding somebody's long-term goals is the only way to structure a loan. What a good lender cares about beyond closing the deal is being their advisor for life in all things mortgage. So later down the line, if a refinance makes sense, rather than getting something in the mail or getting a call from a 1-800 number, it's that lender that calls and says, hey, I think a refinance makes sense because of these reasons. What do you think? There's kind of a holistic approach to working with a lender on all your deals that you can know, like, and trust, because they can help set things up for the long-term future because they know your situation. A skilled lender views relationships as of utmost importance because our reputation is everything, and that's how I'm growing my business. That helps the buyer, it helps the buyer's agent, it helps the seller, it helps the listing agent, it helps everybody in the transaction because I need to operate in a way that makes sense to get the deal done, one, and make everybody happy too. If relationships matter more than rates, then the final question becomes simple. How does somebody actually shop lenders the right way? What you can't do is shop lenders before you get in contract. A lot of lenders will quote something to somebody who isn't yet in contract. So for instance, I'll have clients that say, hey, I'm shopping lender trying to see who has the best rates. We're gonna start shopping for a home in 3 to 6 months. Well, who knows where interest rates are gonna be in 3 to 6 months, but I wanna win their business and win their trust now. So I'm gonna probably offer on a quote a rate way lower than what the market is, but they're not locking an interest rate or getting in contract anytime soon. So when they do get into contract later, I'm gonna say, oh, rates have gone up. Here's what the actual rate is now. So you can't actually shop lenders until you're in contract because anything offered is only offered for that very minute. If the rates change even in the slightest, the offering changes. What you should be doing when shopping lenders on the front end, what you should do is shop personality, shop the way they approach things, shop how they're going to help you. Because at the end of the day, that is way more important than getting an eighth better in interest rate because Joe Schmo at North Carolina Mortgage can get you a $40 a month lower monthly payment. Somebody that is an advisor, somebody that's asking questions to really get the holistic view of your picture, somebody that lets you speak and lets you explain the situation rather than them dominating the conversation and telling you what you need to do, and somebody that's transparent with their numbers and what things look like, and somebody that tells you exactly what I just said. Hey, here are the rates today, here's what we would be able to do, but since you're not in contract, none of it really matters because rates could be different by the day we get in contract. But if we were to get in contract, here's what things would look like. Transparency is of utmost importance. And the reason being is because every number in a lending package is very, very hard to read and very hard to understand. There can be fees, there can be points that aren't disclosed, different rates. The rate could be way different than the APR, vice versa. So a lender not only sending you a quote that looks good, but sitting down with you or having a Zoom call with you to go over line by line what everything is and what you're paying for and what levers can move what, that is what you need to look for in a lender, because then you can build trust, you can give them your full story, and they can present options to you that make sense for you. And I think lastly, quit taking the advice from other people that don't necessarily know what's going on. It's not one size fits all with all these different potential scenarios. I think it might be really hard up front to know if a lender is giving you a pitch versus doing a good job, and that's why at the beginning you should talk to a few, and rather than hearing the pitch and just trying to get to their rate, really hear what they have to say, and the rate at that point doesn't really matter, and then talk to a few, and the ones that are leading with just, hey, I can get you the lowest rate, X, Y, and Z, I can pull some strings, like you kind of get a good feel for that thing. If they sound like a used car salesman and are pushing one agenda versus trying to get like a better understanding of your situation, then you'll know who to pick. The best time to go and talk with a lender is now, essentially. Even if you don't have plans of buying a home, see where you're at and see what it's going to take to get you there. I think starting super early and figuring out a path of how to purchase a home is a lot better than going and finding a home that you like and then trying to rush to get an approval together when you might not be approved in the first place, and the lender says, hey, we got to wait 6 months, but if you would have applied 6 months ago, we could have been purchasing right now. Now you know how to actually shop lenders and not just interest rate. If you know somebody that's looking to get pre-approved or refinance their home, send them this video. It could save them from making a costly mistake.